Kitco News special coverage of Makori's annual Mainnet Summit is brought to you by Oasis Pro.
Hello, I'm Michelle Makori, and this is Kitco News coming to you from the Makori Mainnet Conference here in New York City. And one of the topics very much in focus at this year's conference is the regulatory hostility towards crypto and DeFi. Well, my next guest says that there is a concerted, coordinated political effort to deplatform crypto from the banking system, and that it is being directed by factions from within the White House, and that she is fighting back. Caitlin Long is the CEO of Custodia Bank. Caitlin, great to have you with us.
Thank you. Thanks for having me on. It's great to be on your show. I've watched your work for a long time. It's really an honor to be with you.
Oh, well, it's an honor to talk to you, especially seeing as you're such a trailblazer in this fight against some of the hostility that we're facing. We definitely want to talk about that. Also want to talk to you about the political intersection that you've pointed out between Bitcoin halving cycles and elections. We'll get into that, get your macro outlook, and of course, something that you don't really do, but we are going to get your outlook on the price of Bitcoin. But before we get there, I want to start off with an overview of Operation Choke Point 2.0. Now, the term originally came from an effort by the Obama administration where they were deplatforming businesses that weren't illegal, but they weren't necessarily fans of, like gun stores, for example, cutting their access to the banking system. And then after the collapse of Signature Bank in March, which had a lot of crypto customers, Nick Carter coined the phrase, I believe, Operation Choke Point 2.0, and was saying that there is a concerted effort to cut the crypto sector off from the traditional banking system. So for our viewers that are not familiar, give us a little bit more of a background on what is happening there.
Yes, you're right. It started during the Obama administration. Federal bank regulators in the United States, specifically the FDIC, moved against a total of 30 different industries. And it was applying pressure through the bank regulatory process to debank certain industries. It started with payday lenders and expanded to 30 different industries before Congress and the Trump administration put an end to it. There were lawsuits, and it was revealed that there were some nefarious things going on. The lawsuits were settled. The FDIC agreed not to pursue it. But to your point, it's back under the Biden administration. And we knew it was real from January 27th, actually January 25th or 26th, one of those days. We got an email from a reporter who had been leaked the information that all of the applications at the Federal Reserve and the OCC, the U.S. federal bank regulator that had anything to do with the digital asset industry, were being asked to be withdrawn at the same time. And so we knew that it was a coordinated effort from the very get-go. We had the receipts, so to speak, because we had it in email. And reporters were telling us behind the scenes back in January what was happening. The leaks were stunning. One of the leaks was that Custodia's application would be voted down by the Federal Reserve Board of Governors before we even decided whether to withdraw our application. So the reporters were getting those leaks, and we're fairly certain we know where they came from.
All right, before we get to the Custodia situation specifically, let's give our viewers more of a broader sense of just how big this problem is. I mean, we know, as I said, we mentioned Signature Bank. That was sort of kind of confirmation. We had former Congressman Barney Frank come out and say that this was sending a message, because Signature Bank serviced a lot of crypto customers, and He was saying this is sending a message to the banking industry: do not do business with crypto providers, with anyone in the market. I'm paraphrasing him. And of course, Barney Frank, known for Dodd-Frank, co-authored one of the bills to for greater oversight of the banking industry after the 2008 financial crisis. To be fair, he is on the board of Signature, but the fact that somebody like that is calling it out for what it is. We heard from the CEO of Circle yesterday here at the conference, Jeremy Allaire, saying that 5,000 crypto institutions, I believe, have been debanked. So give us a sense of the size and scope of this problem.
It's pretty much industry-wide. To your point, they decided to throw the baby out with the bathwater and try to kill the industry. What's been fun about being so public and being out front is that insiders have come forward, multiple insiders. Washington, D.C. is a sieve. And just like in the Trump White House, the White House staff in the Biden administration, I'm told, I can't prove this, but I've been told now from multiple people, we're in a civil war with each other. And about 18 months ago, there was a presidential executive order that came out that was fairly positive. Back then, the pro-crypto team was winning. Then came FTX, and then the anti-crypto team won. And there were some personnel changes that happened around between Thanksgiving and Christmas. And it all lines up timing-wise with the crackdown that started happening around that time and into January. And then Custodia was at the beginning of it, and some folks at the time identified, because Custodia had applied to become a Fed member bank, which means a bank directly regulated by the Fed, and was playing ball, doing everything right, asking for permission rather than forgiveness, doing everything to work with regulators. And we were the ones who were the most harshly treated. And so the observation was that it was a so-called shoot the stallion to scatter the herd approach to send the message, as Barney Frank was saying as well.
So is this a coordinated attack then?
That's what I'm told. And again, the evidence that we have from the reporters who were leaked in advance, that the applications were supposed to be withdrawn at the same time. Each application under federal law has due process rights. Our applications are to be considered individually, and clearly they were not. There was a coordinated effort to make us all run. Everyone except for Custodia withdrew their applications. We stood our ground.
How many applications were withdrawn?
At least 3 that I'm aware of. And these are bank applications. These are no small thing. People have invested millions of dollars and years of time to get these applications. And in our case, the application that we put in to the Fed in October 2020 literally said turnaround time 5 to 7 business days. And it was 27 months in at that point when we were finally denied.
So that's an unusually long period of time, safe to say, for that denial. And you are now taking legal action
Correct.
Against the Kansas Fed.
And the Federal Reserve Board of Governors, the federal agency in Washington, D.C. as well.
So to help our viewers understand, you're trying to get a master account,
Correct.
Which means what exactly?
It means a bank account for banks. Custodia is an operating bank through a partner correspondent bank. We have multiple partners. At the moment, we're a state chartered bank, but we have to clear our FedWire and ACH transactions through partner banks. And what we would like to do is have what is statutorily guaranteed to us, which is the ability for us to bank directly at the Fed itself. And that's what we applied for, and that's what we did everything we could to achieve through normal channels, and we're forced into this.
What percentage of banks qualify for this master account?
Well, every depository institution that is eligible, including Custodia, qualifies. And historically, every depository institution was granted a master account. But just like with Operation Choke Point at the FDIC, the Fed started picking and choosing winners about a few years ago. The first lawsuit against the Fed because it arose because the statute actually says the Federal Reserve shall service all eligible depository institutions. And there's an interesting history that your viewers might appreciate. It was during the Volcker Fed that particular statute was enacted in the Monetary Control Act of 1980. It was Volcker himself who begged Congress to treat all depository institutions equally. And that's why the law says what it says. And for decades, the Fed didn't challenge any eligible depository institution, but around the Obama administration is when the federal banking agencies started to grab all this power that they didn't previously have. And of course, the courts are the venue for banks to enforce our legal rights.
What percentage of banks that do not service the crypto sector or do not have direct ties with the crypto sector have been denied this master account?
To my knowledge, pretty much zero.
Is there a case to be made Custodia just isn't eligible?
Oh, no.
Just to play devil's advocate here, can they say?
No,
well,
great question. A great question. There's a reference in the footnote of the Fed's public explanation for our denial of our membership application that it did deem us eligible. So even the Fed itself has deemed us eligible.
Well, I know that Custodia is not FDIC insured.
Correct.
But recently, the list of the banks with master accounts from the Fed has been published. And I believe that there are dozens and dozens and dozens of banks that have this master account that are also not FDIC insured.
Correct. 414 to be precise.
Okay, so that can't be it.
Absolutely not. Although it's interesting because if you look at the old, it was Senator Pat Toomey that got an amendment to the NDAA, the National Defense Authorization Act, in December of 2022, requiring the Fed to open the kimono and disclose who has these accounts because they're so valuable. And when they disclosed that list, it was a shock to a lot of people that 414 uninsured institutions have accounts, because previously, including in 2 prior lawsuits over this very issue that the Fed was able to block, the Fed raised the lack of insurance of the applicants as the issue. And I suspect in one case there was an agreement that I suspect that it was a credit union. That credit union may not have agreed to the settlement that it agreed to had it understood that there were 414 uninsured account holders, because back then the Fed was taking the position that essentially you have to be insured, and that they weren't going to provide an account for the uninsured credit union. Well, it turns out there are 414 uninsured accounts, and so when the real kimono was pulled back, the Fed was hiding something.
Why is Custodia not insured then?
Oh, good question. We applied, and the FDIC told us essentially 18 ways from Sunday. We went through what's called a draft application process where they'll give feedback, and they said don't bother applying. That was not a surprise because of what we just talked about with Operation Choke Point, that the FDIC was not positively inclined towards this industry to begin with.
Yeah.
And there was a debanking wave in 2017 for this industry. So the FDIC had really, it was pretty clear the FDIC wasn't going to play ball, but we tested it because, again, we did everything right.
Well, the FDIC and the Office of the Control of the Currency actually singled out the crypto industry in a statement released earlier this year, saying it's important that risks related to the crypto asset sector that cannot be mitigated or controlled do not migrate to the banking system. The agencies are supervising banking organizations that may be exposed to risks stemming from the crypto asset sector and carefully reviewing any proposals from banking organizations to engage in activities that involve crypto assets. And then they went on to list the risks, including fraud, volatility, contagion. So they're saying they don't want these risks to migrate to the banking system.
Correct.
And then they also add their PS, banking organizations are neither prohibited nor discouraged from providing banking services to customers of any specific class or type as permitted by law or regulation.
Yeah, right.
It's like that little fine print, like on those pharmaceutical commercials where they kind of list the symptoms may include blah, 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 blah.
Well, they don't want to be sued again,
Right, exactly.
And they don't want to be accused of breaking the settlement in the original Operation Choke Point lawsuit.
So they did say that, but at the same time,
Yeah.
they're literally saying important that risks related to the crypto asset sector not migrate to the banking system. So they're pretty upfront about this.
They are, but by the way, I don't disagree with them, and I've said this before. Crypto settles in minutes with irreversibility, and in the United States, the vast majority of the quantity of banks, remember there are 4,236 banks in the United States, the vast majority of which are quite small, they don't have the technology to deal with assets that settle that fast. Most of those banks are still only updating their books and records once a day. Okay, so if assets are settling in minutes, you quickly can realize there could be a bank run at a bank that only settles its books and records once a day, but they're dealing in an asset that moves within minutes and is volatile in price, even if they're just banking those customers. So I didn't push. We chose not to fight the FDIC on this insurance question. But here's also something interesting that your viewers will appreciate. The concept of a non-lending 100% reserve bank. That's what Custodia is. We're a non-lending bank. When you have liabilities that can move at the speed of light, essentially, right? We saw that in Silicon Valley Bank. Literally, no one in the banking industry, not no one, but most folks, did not think that a bank run could happen in the span of a few hours. Now we know it can.
Yeah, these
All
days,
right.
sure.
What do you think the stability of a business model that is making long-term loans with deposits that can be withdrawn in the span of hours? It's fundamentally unstable. And so the solution is not to keep the industry from banking access. The solution is to have non-lending banks that keep 100% of customer demand deposits in cash. And that was exactly what Custodia proposed. It's the old non-fractional reserve lending bank that I'm sure a lot of your customers are familiar with, the Rothbardian Bank. And that's exactly what Custodia is. And that absolutely can solve the risks that the FDIC is concerned about.
So let's get to the why, okay? Why is there this big push against the crypto sector, do you think?
Well, what we've been told is that, based on who is behind it at the Biden White House, that it really is a throw the baby out with the bathwater, and that these folks believed that the entire industry was just built on sand, and that by tipping it over and making it very difficult to move back and forth between the traditional US dollar system and the digital asset system, that the leverage bubble would burst and it would all go to zero.
Or is it because it's a big threat to traditional finance and a big threat potentially to fiat currency and central banks? And they're very invested incumbents that do not want to see this progress because it threatens the establishment.
Yeah, well,
or there's that.
There's that, and there's an interesting question about the intersection of those two things as well. The concept of regulatory capture, the concept of you have to do it our way or the highway, and anyone who does it differently is trying to put a square peg through a round hole. But here's the problem. In the United States, the law is very clear that the states, in the case of state chartered banks, can choose which types of banks to charter. And there are now 6 different states that have chartered non-lending 100% reserve banks. And it's so interesting because it's not political. 3 of those states are red states, and 3 of those states are blue states, proverbially. So this doesn't cut across Republican and Democratic lines. It does cut across 10th Amendment versus centralization of power in the federal government, for those who are interested in that federalism concept. But the Federal Reserve, when the US banking system was set up, if we go back to the founding of the United States, only states chartered banks. And then during the US Civil War, the National Bank Act was passed, and there was a federal chartering authority, the OCC, that you mentioned before, and they had equal chartering power to states. And then roll forward, the Federal Reserve gets created in 1913, and then the FDIC in 1933. Those 2 entities, the Federal Reserve, which operates the payment system, and the FDIC, which is the insurance company for the banking sector, those 2 entities were designed to be utilities. And the way that Congress created chartering authority was it prevents those 2 entities from chartering. They are supposed to service the industry and supposed to defer to the chartering decisions of the states. And as we just talked about, under the Obama administration is when that crack started to appear, and the federal utilities, namely the Federal Reserve, which operates the payment system, and the FDIC, which operates the insurance company, decided to pick and choose who they were serving. That is not legal, and it is being tested in court.
Okay, well, we know that there are certain members of Congress that are very, very unfriendly towards crypto, leading the anti-crypto army, none other than Senator Elizabeth Warren.
Correct.
But when you say this is coming from within the White House, you don't mean Congress necessarily, you don't mean senators necessarily, you mean the White House as in the inner workings of the Biden administration.
This is what we've been told. I admit I can't prove this. This is one of those inside baseball things, but when I talk to folks in Washington, it is an open secret. What I've been told is that there were these 2 factions, and the anti-crypto faction was the domestic policy team inside the Biden White House, and the pro-crypto faction was the national security team. The national security team has always been, actually, believe it or not, even in the Trump White House, the national security team was more favorable. Why? Because crypto is pseudonymous and can be traced. And so they're much more interested in having criminals and terrorists use blockchains because at least there's some traceability, whereas using good old-fashioned $100 bills, there's a lot less. But the domestic policy folks, if you look at their background, they are tied to Senator Elizabeth Warren. And what I've been told, and it's so interesting, every time I appear on a podcast, seemingly, someone else comes forward to fill in more blanks, because there is literally a civil war.
Have you been told specific people within the administration?
I won't name names because I can't prove them.
Okay.
But they're open secrets. That Ryan Makori, who's the sponsor of this, Ryan Selkis of Makori is a sponsor of this conference, has tweeted out the name of the person. And I've never met this person. I have no idea how we ended up on his radar screen, other than he was empowered. And I've been told he stepped into a power vacuum again around that Thanksgiving, Christmas, January timeframe. If you look at what happened, the White House Chief of Staff that role was transitioning, and the National Economic Council head was transitioning, and some of the foreign policy team, the national security team, were also leaving. So there was a big turnover in the White House, and what I've been told, again, can't prove it, but it's an open secret in Washington, is that that anti-crypto army in the domestic policy team moved into the power vacuum and took their opportunity to start this all-of-government crypto crackdown across the entire U.S. government.
And you're saying that this directive is now filtering through to various agencies, right?
That seems pretty clear, because the agencies, they're now admitting they're coordinating, they're putting out joint statements. And like I said in the very beginning, it was a little bewildering because we didn't know why we were targeted and why we were first, but we did know there was coordination among the banking agencies because the press to whom it was leaked was telling us this in email.
Yeah. So Caitlin, I mean, it begs the question, who is really behind the directive, in the sense that usually with politics, there's a money agenda. There's a lobbying agenda that is causing these sort of actions to take place, that's pushing for certain policies to be filtered through. Who's the money behind this? Follow the money, right? Who do you think are the parties that are pushing to have this filter through the agencies, through Congress?
You know, it's so interesting because I don't know that this one is money. At least the people who are allegedly behind it don't seem to, they are as outspoken against the big banks as the rest of us, and concentration of corporate power. If you watch what they're actually doing, though, what's happening right now, the big banks are getting bigger. The smaller banks are getting crushed by regulatory requirements.
They always say, watch what they do, not what they say. So
correct. Are they really protecting the incumbents? I think that's maybe where your question is going. I can't prove that.
Is this directive, again, purely speculation here, but is this directive being sponsored by some of the biggest players in the traditional banking system, do you think?
I don't know, but I asked that question of the insiders because I'm very curious what's really going on here. And again, the fact that there were pro and anti factions in both the Trump and Biden White Houses, I find interesting. This does not cut across traditional political lines. Yeah. And one pointed out to me, what is the motto of the White House? Build back better. What does that imply? Tear down so we can build back better. And that was how this person explained it to me. I don't know if it's true or not, but and then we had the other conversation, which is a lot of this is ending up in the courts. We've seen multiple lawsuits now against the SEC, and then of course multiple lawsuits against the Fed for Fed master accounts, not just involving the crypto industry. And these lawsuits, very interestingly, are what I call bet the farm lawsuits, in the sense that the agencies are opening long-term questions about the extent of their jurisdiction. And these are now in the federal court's hands. And this collective crypto freakout of the Biden administration, Biden White House specifically, I guess they're okay with that. And that was my question to some of the insiders. Why? What on earth are they taking the risk of potentially having the federal agencies have their jurisdiction wings clipped by the court system? And one of them explained it as that they thought if they lose in the courts, it's just going to give them an excuse to pack the courts. Again, I can't verify any of this. I'm certainly no insider, but I'm asking a lot of questions and getting essentially the same answers back when I'm talking to folks in Washington, including some of the insiders. And I'm so grateful. If there are any insiders listening to this and you can fill in more pieces, please contact me. I will protect the names of the folks that I won't disclose them in the press.
Right.
But it's all making sense that but again, I don't think the same way that the folks behind this do. I'm not sure that it's necessarily the JP Morgans or the Citis or the Wells Fargo that are pushing this. I think it may very well be more that there are real ideologues pushing this in a very, very hard way.
Yeah, well, it's interesting because, as you point out, we have these federal regulatory bodies overreaching their powers and now potentially having them curbed through these lawsuits. So where do things stand with your current legal case? What's the status there?
So it's public information that we survived the motion to dismiss. That came out in June, and we are now in what's called the discovery process. And that discovery process ends mid-December. And a trial date has been set for April 2024 if there's going to be a trial.
Okay. April
2024.
What else happens in around April 2024? I believe that's the halving cycle that we're expecting,
Yeah.
which is a very good segue to my next question, because you have pointed out that you think that Satoshi Nakamoto actually timed the Bitcoin halving cycles to coincide with election years. Expand on that.
Well, Satoshi created the halvings every 210,000 blocks, which is approximately every 4 years at 10 minutes a block. And Satoshi created Bitcoin in 2008, right at the peak of the collapse of the US financial system and the great financial crisis. And what was happening right then? A presidential election. So no one, of course, can say definitively that Satoshi timed it to coincide with presidential elections specifically, but every 2010 blocks, starting in October 2008, works out that we get into roaring bull markets typically right around the time of US presidential elections, which is about 6 months after each of the halvings every 4 years.
All right. I mean, we typically get into bull markets around the elections because the incumbent administration wants to create a good economy in order to, encourage voters to keep them in power. But do you think that there was some kind of agenda with Satoshi wanting Bitcoin to perhaps become an increasingly political topic as we're starting to see in this election, or is that a bit of a stretch maybe?
I don't want to put words in Satoshi's mouth. Satoshi was clearly a genius. Did Satoshi think in terms of politics? I don't know.
So it's a coincidence perhaps that we're saying that it's hard. What we do know is that Bitcoin and crypto are seemingly becoming bigger and bigger issues in this presidential cycle.
Well, we certainly have seen, including at this conference, presidential candidates come through and speak about Bitcoin. And we have very strong supporters among the candidates in both of the major U.S. political parties.
Right. I mean, we had Vivek Ramaswamy, one of the candidates for the Republican nomination. He was here yesterday. He's been speaking. He's been very pro-crypto, said he was going to put forward comprehensive legislation if he gets elected, and that he's already drafting it and will release it, I believe. I think he said by Christmas he's going to release something that he's been working on in terms of crypto legislation. But why do you think that Bitcoin and crypto is becoming a bigger political issue? Or is it just in our minds because we're in this world?
Right. Are we talking our own book? It's a good question. Objectively, Coinbase commissioned a statistically sound survey of New Yorkers and found 19% of New York adults own crypto. That's not a small block. Now, how meaningful that issue is to them from a voting perspective is an interesting question. But of course, what you find when you look at the survey research is that it's generally skewed younger, more technologically savvy generations are more likely to own crypto than folks who may still have their VCR flashing 12 o'clock, for example. There's clearly a big generational divide. That is not 100%. In fact, actually, one of the stories I like to tell is that there was a Latina grandmother who was mining Bitcoin in her garage who showed up to the first event where we had an open call for the digital asset industry to come meet legislators in Wyoming back in 2018. So it really does, you can't generalize, but it is true from a demographic perspective that the more technologically sophisticated folks tend to skew younger, and therefore more of the crypto folks tend to skew younger. And that is not, I'm sure, lost on political candidates. The older generations definitely have higher voting turnout. So in the primary elections, you may tend to see more anti-crypto because the older generations are appalled, and by the way, rightfully so, of all the crime and grifting that took place in this industry. Horrific. And the older generations are turned off by that. The younger generations are not. And so don't be surprised if, especially as after the halving, we start to get into a bull market and into the general election, if you see the Biden White House backing off this harsh anti-crypto stance. Also, one of the things that folks have pointed out is that the harshest critic inside the Biden White House announced he's leaving. And so I don't know where he's going. I've never met him, but I don't want to mention names. But what I'm told is that may very well loosen the Biden White House's opposition. We'll see. I think it remains to be seen. But to the extent that the campaign starts to take over and the anti-crypto messaging, especially with that younger demographic, is not working, don't be shocked if they back off this harsh anti-crypto message.
All right, which would be a positive for institutions such as yours and others. So it does seem as though, at least so far, somewhat bipartisan
Yes.
in a very politically toxic, divisive landscape, right? We've got RFK, who's a candidate for the Democrats. Now, granted, on the fringe side of the Democratic Party, certainly not embraced by establishment Democrats, but he's very pro-Bitcoin, very
Yes.
pro-crypto. We've got a number of the Republican candidates, Ron DeSantis, Viva Ramaswamy. Even President Trump has an NFT collection,
Correct.
seemingly
And owns Ethereum.
Yeah,
Right.
seemingly pro-crypto. So safe to say, I think more on the Republican side, but we are seeing some crossover. Senator Gillibrand, Kristen Gillibrand, she's crypto-friendly.
Yes.
So is this one of those rare issues that you think could actually be bipartisan in an era of such toxic political division?
Yes, because it does not cut across those traditional Republican-Democrat lines. It actually aligns more with the old school ACLU freedom of speech Democrats and the
old school,
right. School, right? And the libertarian-oriented Republicans. They're a bloc, and that's where you find Senator Gillibrand and Senator Lummis from Wyoming, who are working on a bipartisan bill. And then on the flip side, the neocons in both parties essentially have aligned against it because they are very pro-surveillance state and are not interested in decentralization of power. Whereas the old school ACLU Democrats and the more liberty-oriented Republicans are more interested in decentralization of power. So it is strange bedfellows. It's not cutting across party lines.
Which bodes well for the industry.
I think so.
And possibly one of the reasons why there's some very positive Bitcoin forecasts for around about the election time. Now, I know forecasts aren't really your department in terms of price, but curious what you have to say about this one. We know Pantera Capital's model is showing Bitcoin crossing around $100,000 around the time of the US presidential election in 2024. According to the latest report, if history were to repeat itself, the next halving would see Bitcoin rising to 35,000 before the halving and then 148,000 after. What say you? Do you find this target plausible?
Those models are implying a big rally. Absolutely, it's plausible because the models, if you use them for backtesting purposes, have worked reasonably well. They have undershot in this most recent 4-year cycle, they undershot the upside and overshot the downside a little bit, but not that much. If you look at the stock to flow models, if you look at some of these Mayer multiple models, they've actually worked reasonably well as a valuation. And the Kitco customer base would certainly understand this, because commodities have always been valued on the basis of stock to flow. Why is gold so valuable? The answer is it has a very low inflation rate. What does that mean? It means the flow of new gold is very low relative to the stock of outstanding gold. That is why gold, throughout multiple parts in human history where we didn't even understand that peoples necessarily interacted and could share ideas, evolved as money. Why was gold money in so many different cultures across such a long period of time? Because it had a low stock to flow. In other words, the inflation rate was approximating the rate of population growth. And therefore, gold became the tether for money and credit. And so that model of valuing commodities has stood the test of time. And I see Bitcoin as just a digital commodity. It's a digital version of gold. And so there's no reason why the stock to flow commodity valuation models wouldn't apply to Bitcoin as well. And they have worked relatively well. That said, you're right, I don't make forecasts. And a model is good and it works until it doesn't. So I don't put too much weight into it. But on the other side, Bitcoin has unforgeable costliness, a costliness that cannot be counterfeited, in other words. And that's what makes it scarce. And that over time should give it more value relative to the inflating fiat currency regimes in which we all live.
All right, well, we'll take that as a potentially yes. I do think we can see Bitcoin at 100,000 by the end of 2024.
Yes.
Loosely paraphrasing you there. Well, speaking of inflation, I do want to quickly get your thoughts as we wrap up on the Fed and on the macroeconomy also leading into an election year, which also plays a role in that. We heard from Fed Chair Jerome Powell yesterday, the Fed keeping rates steady for right now, but seem to indicate that there could be another rate increase on the horizon. What's your outlook in terms of what we can expect from the Fed and what that would then mean for the macroeconomy?
Well, the Fed is, I think, going to keep raising rates. I think they're going to surprise people with how much they're continuing to raise rates to try to get inflation under control. But
you think more than one rate hike?
Yes, again, I'm not in the business of forecasts, but yes, I don't believe the consensus is correct, because inflation is picking back up. Those who forecasted inflation to pick back up have been proven right, at least in the short term. And there's some very interesting data underlying what's going on. I used to work with corporate treasurers during my Wall Street career, and the corporates locked in low long-term interest rates. So they're probably borrowing at about 2%, and they're earning 5.25% on their cash by just keeping it in T-bills or money market funds. So these big corporates are actually getting richer. They're getting bigger as a result of their really effective corporate treasury strategy. And that's showing up in some very strange data that there historically has been. Albert Edwards of SocGen pointed out historically there's been a very strong correlation between corporate profits and the ISM index, and that correlation suddenly broke in the last year. And his explanation for it is that corporate profits are counterintuitively going up in a rising interest rate environment because the large corporates have such huge cash pools. And they're even though they have large net debt, a lot of that has to do with how money moves globally. They have more cash than they have debt, and their debt they're paying at 2%, and they're earning 5% and pocketing the 3% spread. It's the inverse of the old 3-6-3 rule that people used to describe banking: borrow at 3%, lend at 6%, and you're on the golf course by 3. Well, it's the corporates now that are effectively executing that model. Borrow at 2%, earn 5%, and you're on the golf course by 3.
All right, so you're seeing potentially further rate increases. What does that mean for the economy? At what point does that start to really hurt the economy? Do you see a recession ahead for next year?
It's already happening in certain sectors. It's already happening in the labor markets, right? So, but recognize that it's very tilted. It's very unbalanced.
Yeah.
And what I just described, these large corporates getting richer, it's the old phrase, the rich have assets and the poor have debt. As the Fed continues to raise rates, the rich are getting richer because they're the ones that are owning these T-bills that are paying 5.25% risk-free right now. Yeah.
And that is a whole other conversation we're going to have you back on in terms of how Treasury bills are actually creating more demand for stable coins. We'll circle back to that next time we have you on.
I'd be happy to.
But I know we're running out of time. You have to make your presentation soon. So finally, as we wrap up here, speaking of the banking sector, tell us about the latest as Custodia, because you are now a fully operating bank despite all of these legal hurdles.
Yes, we are a state chartered bank. Like I mentioned, we have partners clearing our FedWire and ACH transactions for customers. We are not licensed to do business in every state, so check our website. And also, we are not FDIC insured, so have to give the obligatory disclaimers. And, drum roll, we are very close to launching Bitcoin custody. Because we're a bank that is designed for fiduciaries, we have a different custody model than is available from Bitcoin custodians. First of all, I would always encourage folks, not your keys, not your coins. Self-custody if you can. But if you are going to custody, the approach that we're taking is the closest to the ethos of Bitcoin. And the bank that we've designed is the closest to the ethos of Bitcoin as well. Let's not have a levered bank. This is a bank that doesn't lend, sits 100% in cash reserves. And when we provide custody services for custody customers, here's the drum roll, we are custodying actual customer UTXOs. The UTXOs are the unspent transaction outputs of Bitcoin. Our custody model is not available in the market today. Everyone else pools customer custody assets in an omnibus account, and each customer owns a pro rata share of that omnibus account. In our case, we will custody the actual Bitcoins of the customers.
So individual customers, but businesses.
Businesses, yep.
And you will custody their particular specific Bitcoin.
Correct. Yep, they don't have to transfer the Bitcoin to us and store it in an omnibus wallet structure. That is not how Custodia set up the Bitcoin custody. And as a result of the fact that we're custodying the actual UTXOs, every customer will always be able to watch and ensure that those UTXOs don't move, because they can just check their
specific deposit,
on the Bitcoin blockchain.
Okay.
It's a different custody model, and it's very much designed for long-term holders, very much also designed with Satoshi's ethos in mind. I'm a hardcore Bitcoiner. I've been around Bitcoin since 2012, and when we thought about a way to create a financial institution that is a safe and compliant bridge between these two financial systems, we talked earlier about the way for the digital asset industry not to harm traditional banks. We also conceived of a new breed of bank that would not harm the digital asset industry either, by bringing the bad practices of traditional finance into the Bitcoin industry. We are leaving all of those in the dust and building what is really a fee-based counterparty, as opposed a fee-based service provider rather than a spread-based counterparty. I think most of your readers and listeners understand the difference, because when you make a deposit in a bank, you're making an unsecured loan to a leveraged institution.
Right.
If that bank is a fractional reserve lending bank. And we're trying to break that distinction by having a bank that's non-lending and will actually just store your dollars for you.
And when does this launch?
Bitcoin custody, I hope, knock on wood, our first live customer will be within a couple weeks.
Okay.
It's that close.
All right, well, good luck with that. We will have to
you.
have you back to discuss that and the business model behind that. But I have to let you get on stage now.
I appreciate that. Really fun
Thank
interview.
You so
Thank
much.
you.
Great
You did
chatting
so
with you.
much homework. I really am very impressed. Thank you.
Well, likewise, thank you. And we'll look forward to chatting with you again soon. Okay,
thank you.
Thank you.
Kitco News special coverage of Masari's annual Mainnet Summit is brought to you by Oasis Pro.